Hello and welcome to another episode of Opto Sessions. I'm very happy to introduce Christian Magoon, founder and CEO of Amplify ETFs. A recent acquisition of ETF Managers Group brings the total AUM at Amplify to over 9 billion. How are you doing today, Christian?
I'm doing well, Ed. Good to see you again, and thanks for having me on.
Where are we calling from?
So I'm in Colorado today, and just got back from the world's largest ETF conference, ETF Exchange down in Florida, and spent a variety of days down there talking about ETFs and a variety of investment strategies. So very timely to be with you here today to talk about a couple of interesting market segments.
Yeah, I mean, there's obviously a lot going on in the markets at the moment, and we've chosen to talk about a few of the most interesting, I believe, today. Obviously, a couple of these are available at Amplify. Cybersecurity, the first one we could stop on, and particularly interesting because lots of companies are starting to use a lot more cyber, or having to, because of the risk of attacks. And it appears like it's a sector that doesn't really have any ups and downs because of the necessity to have it throughout the business cycle, because you can't afford for the business to shut down. So yeah, I thought we could start there. It's projected, I believe, to increase from 200 billion to around 350 to 400 billion addressable market by 2026. What do you think are the key factors propelling this growth?
Yeah, well, I mean, cybersecurity is super timely here, right? With all the geopolitical tensions that are happening, and certainly that's probably one of the factors that's propelling this growth is geopolitical tensions. We're in a Cold War in a lot of ways with a lot of countries where they have units that are willing to deploy, cyber attacks, and that's kind of a cold way to confront a company versus a hot way in terms of actual weapons and missiles and soldiers. So, we're seeing, common offenders, whether that's Russia, China, even, earlier this week, stories out that the US actually deployed a cyber attack on an Iranian warship that was potentially directing, Houthis to target commercial shipping vessels. So many countries are using cyber attacks as a way to kind of put their elbows out to disrupt kind of nations they're having conflict with. And you can't rule out the when a government starts to spend in areas like this, it really can move the markets. Aside from this geopolitical tension and kind of government spending, you also see corporations certainly being victims of attacks. Their reputation is on the line. They potentially have liabilities. So corporations around the world are, now turning this into a C-suite issue. Boards are demanding that they spend money on cybersecurity defenses. And then certainly whenever attacks happen, there's a lot of money spent going back and actually kind of rectifying those systems and sweeping them to make sure that they're okay. And then finally, now you and I are living our lives so much more online. There's so much more content, whether that's banking information or ways we're paying for things, even some of our personal information, potentially photos, messages we're sharing with people. When more assets are online, unfortunately, criminals go online more and more to go out and get that. And cybersecurity, at least some of these programs, once they're created, they're very easy to run. They're very low cost, and they can be done in mass. And all you need is a small percentage of those attacks to work. So, increasingly, average everyday citizens are buying, VPNs and firewall or cybersecurity software for their computers and devices. So when you look at, governments, corporations, and individuals spending or increasing their spending in any theme, that's usually a good place to be for investors. And I think you kind of started this off perfectly, where you said, this is kind of a growth segment, which that's important for many investors to have exposure to growth. But in a lot of ways, it's defensive as well, because the underlying spending really is a necessity. Cybersecurity is really like a modern day utility. You have to have it. And you really can't back off, especially if you're a government or corporation, due to these liabilities, due to these constant attacks and the reputational damage that can happen. So we really think the cybersecurity theme is built to last and really underrepresented. Just one last stat I'll give you. If if you look at our cybersecurity ETF, which was the first in the world, ticker HACK, HACK, and you look at its overlap by weightings with the NASDAQ 100 or with the S&P 500, both of those overlaps are less than 3% in terms of the securities weighting in the NASDAQ 100 and the S&P 500 relative to HACK. So most investors don't have a lot of exposure to cybersecurity if they just own the S&P 500 or the NASDAQ 100. So again, we think this is a really important theme to add to a portfolio that has some unique characteristics between being growth oriented, but also having a measure of defensiveness.
Yeah, that's. I think it's only about 7 months ago. I mean, these stories come out all the time now, but it was the British Library. It tends to be often these industries that aren't so tech savvy, if you like. But the hackers got into their systems, and it's not just the website. They go into the back end. They lock out all the users that are using all the tech systems for just managing work. And I think they still haven't been able to get access it 6 months later because they wouldn't pay the demand that they were requesting. And this is happening all the time. And I suppose as soon as this happens, there's a necessity to spend on cyber.
That's right. If you're not on your front foot as an industry, it's not a good look for you, and you could have your whole business disabled. We've had a similar incident with hospitals here in the U.S. who didn't have appropriate cybersecurity protections, where they've locked down patient records, they've locked down access to not only medical files but medical equipment, and it's a really big issue. And it could be, we think, one of the biggest spends for many companies going forward in the future, because you can't have your business locked down and expose your patients or your clients to this type of liability. And unfortunately, due to kind of, again, the whole digitization of our world, it's becoming more and more common.
Technological innovation is causing unprecedented disruption. Octo is here to help take advantage of a world in flux. From AI to blockchain, find the stocks and ETFs related to 50 plus powerful growth trends. Just scan the QR code to download for free.
Yeah. And who are the largest clients of these companies generally? Are they just typically is it the Fortune 500 that's going to be the ones that are spending the most on this moving forward? The ones that have, more to lose, more.
Yeah, that's right. So, typically it's been kind of the largest companies who especially are publicly traded. There's certainly legislation here in the US, as well as kind of best practices from a publicly traded company standpoint, to have measures in place on cybersecurity and the vendors that you use to have those measures in place. So there's, kind of liability oriented issues that face these companies. So they have to spend. Believe it or not, governments are also very large spenders in private cybersecurity. They often have their own defenses internally, but as attacks, vulnerabilities, or even testing happens, many of the governments outsource to these private contractors. So I think, it kind of comes from the top down, if you will, because the bigger risks are there. But certainly you're seeing an emergence of even everyday people having to now, find cybersecurity solutions, whether that's VPNs or scanning software to protect their devices because of, ransomware issues and how traumatic that can be. So it's governments and corporations kind of, really pushing down the spending. But again, we're seeing, quite a bit of an increase at the individual level. So there's almost no, sector that really can ignore this nowadays. To your point, it used to be more companies that had high-tech businesses where they had trade secrets, or maybe operated like infrastructure that could not be disrupted, whether that maybe is power or transportation. So there was an essential nature. But we're seeing it now migrate to, libraries and other types of businesses or concerns that maybe you wouldn't think of initially. But again, the cost of, once you create this a cyber attack or a scheme to access or control this data, its scalability is immense, and the cost of deploying it is very low. And all you need is less than 1% of these computers to be not defended, and that can allow you into very large systems and sometimes ecosystems. And as you know, the damage can be substantial. So this is another form of, essentially modern day insurance, if you will, on the technology side to protect against those losses and those liabilities. It's really utility in nature, and that wasn't the case 10 years ago. In some ways, that was great back 10 years ago. You didn't have to worry about it, but of course, digitization comes with a lot of great efficiencies too. So I think we've probably reaped more efficiencies from becoming more digital, worldwide. Unfortunately, there is a downside to that.
Yeah, and they're also calling this the future, this era of sort of robotics and automation. And I can only assume as that sector grows, some people are forecasting to grow exponentially as these robots become cheaper, and there's many different innovations that we're starting to use. A lot of them in the sort of supply chain for deliveries and etc. initially, but everything's online, like you're saying. So it's all digital. Everything's going online. So the risk is gigantic for any of these companies that their entire business is based off of the network connectivity. So my question would be, with the advances in AI that we're also seeing, which obviously will support this sort of need for these networks are online as well, but it also does allow the hackers to be more sophisticated potentially in their attacks. So could you see that as a reason why it might fuel even further demand for people to have protective measures against this?
Yeah, I think it's going to be an arms race, like you said, because we're only seeing more of our lives becoming interconnected with the web, and computers and automation. So, if you're a bull on artificial intelligence, AI, and certainly that's been one of the best performing market segments in the last year and a half, a market leader, you have to look at, what technologies will be coupled with AI and kind of grow right alongside of it. And just like the gold rush, certain people, went out and mined gold here in the U.S. and created fortunes. But, there was a lot of other fortunes made with people who sold pickaxes, shovels, blue jeans, and equipment. And cybersecurity is like that. It's a pick and axe play relative to AI. By the way, so are blockchain companies, because blockchain is going to have to be one of the solutions there to build trust. But that's a whole nother market segment. Cybersecurity, though, is going to really see an arms race here, because AI will create now, or have the ability to create, new and inventive ways to attack systems, computers, software on the dark side. And then on the quote unquote white side, the white hat group is going to have to, kind of reverse engineer this or try to get ahead. So I think there's going to be an arms race in terms of not only, AI, but also, getting ahead using AI to build out cyber security solutions. So this is, again, another kind of tailwind, if you will, for this sector, because whether you, see kind of the trend on AI, on robotics, on kind of this interconnectedness, all of these areas mean that there's more vulnerabilities. And companies, governments, individuals are just going to have to be more apt to secure. It also could create a lot of M&A in this business as well, because it could end up being that the cybersecurity companies that lead the charge, have the most capital, have the most scale, have the most access to AI, maybe even quantum computing, to kind of stay ahead, if you will, against hackers. So that's another interesting kind of trend that we think will emerge in cybersecurity, kind of this M&A activity, which often happens in industries when a lot of demand and scale happen at the same time.
Yeah. And what about the Hack ETF? Could you just comment on some of the holdings in there? What sort of companies have we got in the top 10?
Yeah. So, Hack is an index-based ETF. I think what sets it apart is, to be included in Hack, a company has to have 90% or more of their revenue coming from cybersecurity. Most ETFs that are in the space have a 50% or more hurdle. And indeed, Hack historically, it was the first cybersecurity ETF, had a 50% hurdle. And because when Hack, launched nearly 10 years ago, there weren't as many pure play companies available. So that 50% standard was allowed you to kind of capture companies that had robust cybersecurity businesses, but also did other things like networking, et cetera. Well, this kind of new world we live in and the growth of the cybersecurity industry has led to the ability for the index to become more pure, and Hack to, in my opinion, be the purest ETF in the space with this 90% revenue capture. So, looking at some of the top holdings, and of course, those are available on our website, amplifyetfs.com. Hack's top holdings include Broadcom, Palo Alto Networks, CrowdStrike, Cloudflare, Zscaler. These are names that you hear quite a bit during earnings season that are kind of bellwether names that really focus in on the cybersecurity space. And these are, companies that aren't just making money from, creating software or services to protect. Often these types of companies are called in to go out and do the forensics of cyber attacks and review systems, both on the corporate and the government side. So, not only do they have clients, they often are called in to kind of do the cleanup. And that's unfortunately a good source of new business. Many of these companies have substantial subscription-based revenue because of their services, and reoccurring revenue is a pretty nice thing to have in today's market. So, cybersecurity, again, we think is a really attractive area. A lot of growth going forward, unfortunately, and frankly, as an investor, no one likes to read or see news about cybersecurity events or hacks. But when you own a product like Hack that invests in these cybersecurity companies, a small part of hearing about those negative events maybe makes you feel good because you are investing in companies that are seeking to protect and remedy that. And in fact, it probably helps your portfolio in the long run due to kind of those adverse events. So I think you invest in Hack for the growth, some of the defensiveness around spending, but then also that you're helping invest in the future of protection, which I think we're all, exposed to those risks today more so than ever.
Yep. Yeah, so definitely a very unique theme. I think that, we don't really get this. Whatever happens, it's probably going to do well, just the nature of where the world's going. And, it definitely stands out in all the themes that we look at. You can see that in the movements of many of the stocks are less volatile on a day. It's almost like slow, steady, consistent growth, which is because they're just growing at a good rate. It seems every quarter, which is just really good to see. But yeah, well, thanks for that, Chris. Cannabis, I thought, is the next one we could look at, sure, which has also been really interesting. It's been obviously a sector that's not done as many small caps, didn't do well over the last sort of 18 months or so, but over the last 6 months, it's been just showing signs of a recovery. In particular, there's been a recent buzz around potential changes in legislation, even rumors of rescheduling or descheduling, and movements towards legalization in states like Pennsylvania. What impacts do you foresee on the market going forward? Any comments on that?
Yeah, so cannabis is definitely another theme that we think has a very long kind of life cycle, not only here in the U.S. but globally. And it's been disappointing the last for most of the last 18 months or 2 years. Recently in the last, say, 3 to 4 months, it's had a nice run. And in fact, year to date, here in 2024, cannabis has been one of the top performing themes, more than 35% on average across the cannabis ETFs. And that's really due to kind of, as you mentioned, this, I don't know if I'd call it a rumor or a trend that, maybe legislation or a change in government posture from the federal government is coming here in the U.S. Cannabis is still a Schedule I drug in the U.S., which puts it in the same category as a drug like cocaine. And, that creates a variety of issues for cannabis companies. This is a little bit of an odd kind of juxtaposition because, the majority of states here in the U.S. from the state standpoint have legalized cannabis in one form or another, whether that's for medical use, which is fairly widespread in the U.S., or for adult recreational use, which is becoming more widespread. In fact, most U.S. opinion polls have the number at over 70% of Americans think that cannabis should be legalized. So the federal government seems to be a little bit behind here. And around 4 to 5 months ago, we saw some movement that maybe they're going to catch up to public opinion and what most of the states are doing, and that is really moving cannabis from a Schedule 1 drug down to a Schedule 3 drug. And why that's important for cannabis companies is today, because they operate in a business with Schedule 1, with a Schedule 1 drug, they're not able to deduct any business expenses when they do their taxes. And by being able to become a Schedule 3 drug, they would be able to now deduct business expenses like any other business in the U.S. Well, specifically what that does for cannabis companies is it makes them, in many cases, profitable. You can imagine running a business and not being able to deduct any of your expenses against your income. There's a different profile of that business versus being able to deduct normal and ordinary business expenses. Once that happens, the profile from a financial standpoint changes dramatically from cannabis. Then a follow-on happens. If you're now in the Schedule 3 side, you probably will be able to see some movement on access to capital markets. So currently, there are some bills floating around that are revolving around banking for cannabis companies. Most cannabis companies can't bank at normal banks. So literally many of these companies deal in cash and have vaults, etc. Very inefficient. But in addition, they're very limited in terms of their access to capital, whether that's being listed on smaller exchanges or less liquid exchanges. Institutional investors can't actually invest in a Schedule 1 type business. They potentially could in a Schedule 3 business. So there's a variety of domino effects that would happen should essentially the DEA and FDA reschedule cannabis. And we've seen in the last month a variety of sources indicate that this is a priority. When you look at this from the federal government standpoint, being able to kind of legalize cannabis and use it as a tax generator in a variety of different ways. Seems like it would be helpful. Government spending and government debt, both are at fairly, at our all-time highs. So that's a motivation. Also, we're in an election season here, so it's probably politically advantageous to be the party that, or the administration that, legalizes in some form cannabis, whether that's, descheduling or providing access to capital markets. So this is a kind of an exciting time. We'll see in the next few months kind of how this plays out. And you can see cannabis stocks move dramatically, at least US-based cannabis stocks move dramatically in terms of price movement based on headlines coming out of Washington. This would be the one unique theme, I'd say, Ed, that retail investors have an edge over on edge versus institutional investors. Generally, institutional investors in almost every segment of the market can get in first. Usually through private equity, and ultimately retail investors get to participate at the tail end. Well, because of these issues regarding cannabis, we're not seeing the institutional engagement. In fact, again, almost no institutional investors in this space. So, these cannabis ETFs allow retail investors to get in ahead of the institutional investor. By the way, that's not just institutional investors kind of investing in these companies once they become, compliant with federal law. But, the other side of the coin is once many of these cannabis specific companies have access to capital markets, we expect to see a lot of mergers and acquisitions with traditional consumer packaged goods companies. So whether that's, tobacco companies or the Johnson & Johnson of the world that do a variety of different types of health oriented products, we think that many of these mainstream brands are going to go out and acquire these different cannabis companies to become units within their overall business. Because let's face it, Johnson & Johnson knows how to distribute products to consumers that might help with anxiety or sleep or inflammation. Likewise, the tobacco companies know how to package and distribute cigarettes. Alcohol companies know how to distribute adult use type products. So what could happen here is, again, a variety of things very quickly: access to capital markets, increased profitability, institutional investors coming in, mergers and acquisitions. So this is one of the reasons we think this space is really going to be exciting. And then once that happens, I think will play out over the next 10 to 15 years as a consumer packaged goods story. And as I think we'll talk about later, there's a variety of interesting use cases for cannabis.
Yeah, I like the fact you mentioned as particularly interesting time due to the upcoming US election. They're not forced, but there's some pressure there because they want to do well in the polls.
Yes.
I had a question about some more global question, because Germany also moving towards legalization of cannabis. It's been saying that this is like happening. It's just a matter of when it happens, not if. We should also join Malta and Luxembourg in the EU, who have legalized it as well. Where do you see the most significant market opportunities? Because I know there's Amplify's got a range of ETFs, some focused on the US specifically, others more global. Where do you see the opportunity going forward at the moment?
Yeah, so we definitely think this is going to be, similar size to traditional consumer packaged goods marketplaces. And the U.S. tends to be one of the largest in the world. Certainly China is made progress there, as well as India, but I think probably those markets are going to be further behind. It is interesting to note, traditionally the U.S. has kind of been behind, let's say Europe and other countries in terms of adult use type substances. I mean, we had the prohibition of alcohol in the U.S. for a number of years, and that hasn't really been the case in Europe. We also have older drinking ages, for example, here in the U.S. and other things than potential many countries in Europe. So this is kind of unique that the U.S. seems to be leaning into this a little bit more, at least from a state perspective and from a public opinion standpoint, than maybe the rest of the world, for example, Europe. However, it does seem like that's starting to change in Europe. And we think that will be a pretty substantial marketplace. Maybe, the second largest in the world. A lot of the other Asia Pacific countries are even further behind in terms of their view on kind of these substances.
Yeah.
I think the U.S. is likely to be the largest market for the foreseeable future, followed by Europe, and then several other countries. Canada, certainly, they've been kind of the lead in the globe, so in terms of their embrace of cannabis and some of the capital market access Canadian companies have. But we think this is ultimately a global story, with likely the U.S. continuing to be the biggest market. And again, we're talking about really two markets here: adult use, so similar to maybe alcohol or let's just say tobacco, and then this other side of the coin, which is really kind of the wellness market, which has a lot of potential as well.
And do you have any sort of thoughts on which side of that market you think offers the best opportunity?
Yeah, I mean, so one of the reasons, I think Amplify was mostly intrigued by this marketplace is the wellness aspect. When we see that, for example, like CBD cream in CBD used for inflammation and other types of kind of medicinal purposes is, one of the top growing categories in U.S. drugstores. And then we see that the group that buys the most of it are kind of senior citizens and people who are retired. That really gets our attention. And we think that, CBD is just one kind of compound that's found in the cannabis plant. There's close to 30 other types of compounds like CBD, but have potentially different use cases that are being researched. So we see a lot of potential for the wellness side. With that being said, you cannot deny the adult use side. And the adult use side is really kind of can cannabis use either through a variety of methods, can it take the place or take market share from alcohol or tobacco? And there are a variety of instances here in the U.S. where we see in some of the states and some of the kind of marketplaces in terms of alcohol sales or alcohol receipts or taxation relative to cannabis taxation and receipts. We're seeing in some cases cannabis catch up or replace alcohol in terms of kind of the leading adult use substance. There's a fair amount of research into kind of the different impact, the different health impact that cannabis may have versus alcohol or tobacco, and certainly there are a lot more, at least initially today, more risks known about tobacco use as well as alcohol use. There are a lot of research being done on cannabis, but initially it seems like the research seems to point to maybe some of the less impact from a variety of standpoint, whether it's potentially from a cancer risk standpoint or an impairment standpoint. So I think the jury's out there, but I think if cannabis is at least on par with tobacco or alcohol as an adult use alternative, we think that the market could be fairly robust there. With that being said, I think personally I'm more intrigued by the wellness side, and when you look at all the research, and it's across the spectrum of what you go into a drugstore today to solve, whether that's again inflammation, anxiety, sleep. In some cases, there's been some interesting, breakthroughs on specific conditions like nausea or even seizures. So there's a lot going on there. Cannabis has kind of been a substance. Well, it has been a substance that hasn't received the type of rigorous research and funding because of its status as essentially a Schedule I drug. And in the last 2 years, especially, that's changed as states have changed. So there's a lot of money now going into researching all of kind of what cannabis is, everything from what THC is to CBD to some of the other nearly 30 other compounds with these 3-letter abbreviations, and how those compounds may be able to be used in different ways to maybe more effectively treat issues that the human body experiences today versus opioids or other synthetic substances that unfortunately in many cases have proven to cause more problems, whether through addiction or abuse or side effects. So I personally think that the wellness side is quite promising, and I think we'll know in the next several years a variety of new use cases. And the science, it's kind of coming at a great time because we talked earlier about AI, the computing power, the turnaround time to be able to go in and research compounds and their impacts and the different combinations that are available has exponentially grown. So I think this whole AI push and how it's affecting life sciences, whether that's vaccinations or studying different compounds and or trying to create new use cases. I think it's happening all in a nice parallel time frame as cannabis is emerging as again a plant that is now receiving a lot of research and testing to see what this plant may be able to do. And again, we know that there's roughly 30 different compounds that need to be researched more robustly. So over the coming years, I think there's a lot of promise there, and that certainly could be something that propels cannabis. Potentially at some point, maybe we have a wellness cannabis ETF and an adult use cannabis ETF. Different companies, going after different verticals.
Yeah. And so today, how can you get exposure to this theme at Amplify, and what sets those ETFs apart from others in the industry as well?
Yeah, so we have, currently 3 different cannabis ETFs. We started with one several years ago, and that is an actively managed cannabis ETF by Tim Seymour of Seymour Asset Management. Many U.S. investors know him from his continued presence on CNBC and the show Fast Money. He's been a longtime cannabis investor and has focused a lot of his time on emerging markets, whether that's emerging market sectors like cannabis or actual emerging market countries. So pretty nimble and effective investor. So we started an actively managed cannabis ETF with him a number of years ago, and CNBS, is really split at this point between U.S. company exposure, having exposure to MSOs, multi-state operators, and then Canadian companies, which Canada is kind of where it's at in terms of most companies being available on exchanges in Toronto and in Canada, being more liberal, if you will, with their capital markets access. So that's one solution we have. Recently we've done this acquisition where we acquired 14 different ETFs, and 2 of those were cannabis ETFs, but they're different than CNBS. So the first one is MJ, which is the original cannabis ETF, the first cannabis ETF in the United States. That is an index-based product. So it's rules-based in terms of how it selects its exposure to cannabis companies. That's about 60% US exposure and about 40% Canada and other country exposure. So more a global rules-based approach. And then we also have MJ US, which is kind of a sister fund to MJ. The difference is it only owns or has exposure to U.S. multi-state operators, so U.S. focused only, and that is technically an active ETF, but it actually really tracks an index. When you own swaps on securities, which MJ US does, you have to be structured as an active ETF, but the actual security selection of the companies is exposed to is done through a rules-based index process. So really, to sum up, we have kind of a global actively managed cannabis ETF in terms of CNBS. We have a global index-based product, and then we have another and a US-focused product in MJ US that has a rules-based approach to selecting securities, but again, is technically an active ETF. So you see different performance levels in all 3 of these products based off news events. So, for example, when you see positive US news, which is kind of ruling the market, the product that has the most upside there is MJ US because it's 100% exposed to US names. If this U.S. trend fails or stalls, or on days there's bad news, MJ US will be the worst performing of our suite, and you'll see MJ and CNBS do a little bit better. So kind of different flavors for different people who want unique approaches, to invest in this space. And when you look at them, many of them have a lot of the same company exposure. There's certainly kind of similar leading companies that are here in the U.S. in the form of multi-state operators. Same with Canada. However, there's different weighting schemes that all 3 of these use.
And obviously, ETFs, good way to play this sector because it's quite volatile. So, and different companies get different benefits from different news. So you get that average in the ETF, which can mean it's a little bit less up and down in your portfolio if you're doing the single equities. Just before we wrap up, I wanted to talk about one other theme, the Israel tech ETF.
Yeah.
What factors do you think contribute to Israel's historic success as a global technology hub?
Yeah, I mean, part of it is really, the scrappiness and kind of the survival nature that Israel has had to embrace. Being in a contested area of the Middle East, and starting out as a nation that didn't have a ton of resources, for example, from a food perspective, being in, in a country or an area of the world that's quite arid in a lot of places, not everywhere. They had to be really kind of innovative. So, Israel is known as the startup nation, and when you look at some of the unique aspects of Israel, you find out that as a nation they spent more on R&D than any other nation relative to GDP. By the way, number 2 there is South Korea as another kind of innovation hub. If you look at Tel Aviv, it has the most startups of any single city in the world. So there's a kind of a culture of creating new technology, being innovative from Israel as a country, and it's reflected in many of these real breakthroughs that have happened, historically out of Israel. There's a variety of technologies, and we can talk about them here in a second, that came about from Israel, and then even today, when you look at kind of the mix of types of companies that are there, it's all these kind of emerging sectors. So a unique way to play Israel. Many people, who are interested in Israel might buy a general kind of Israel country ETF that kind of owns like the standard companies, but make no mistake, iTech is kind of like the NASDAQ 100, if you will, of Israeli companies, whether they're based, in Israel or they have, a majority of their assets in Israel. I also note that there's over 400 companies worldwide that have research centers based in Israel to kind of create new innovations. So this is a really unique country, and having access to these companies that are innovating across the spectrum is exciting. And again, it's one of the new ETFs, iTech, ITEQ, that we've acquired in this recent transaction. So we're excited to have it as part of the Amplify ETF lineup.
And even though we're talking about Israel, a lot of these companies, people probably know, they've got a global presence. They're not, just present in the Israeli market. So can you just touch on some of the software sectors or companies, in the top 10 in the ETF, so that people can just understand who we're talking about here?
Yeah, so let me give you a few names like CyberArk Software, Checkpoint Software, Amdocs, SentinelOne, Wix.com, Monday.com, SolarEdge, companies that I think most people probably have heard some of those names. When you actually look at the sectors that are represented inside, iTech, 26% of the portfolio is cybersecurity and defense tech solutions. But another 25% of the portfolio is software on the fintech side, as well as digital advertising. Another 24% is big data and applied artificial intelligence. Then you have a variety of other sectors that are 9% or less, including clean energy, water tech, robotics, industrial automation, biotech and medical devices, and communications equipment. So it's really a plethora of the technologies that are being kind of developed today, and kind of exciting to see what's come out of the Israel historically. I mean, the firewall was invented in Israel. Drip water irrigation was invented in Israel. The answering machine was invented. A lot of the sensors around autonomous driving related to a company that most people know, Mobileye, have their origins in Israel. A lot of solar applications. So this is a great way to own these companies, and they're really under-owned for the most part, especially if you own a general Israel index ETF. We think there's probably a real special situation here, given some of the recent issues in kind of the Israel geopolitical standpoint, whether that's the judiciary conflict that happened that kind of pushed down Israeli markets in the last year. And then right after that, the Hamas attack and the continuing operation going on there. You're really buying these companies and this index at what we think is a depressed valuation relative to its long-term track record, and probably a real special opportunity here to be able to buy innovation at a discount. Very hard to do that right now in U.S. markets. So we think iTech is actually pretty timely right now.
Yeah. Well, thanks very much, Christian. It's been great to go through just a couple of the, or 3 of the ETFs that are available at Amplify. Before we finish, is there anything last words you'd like to leave with our audience?
No, I would say, Amplify ETFs is a sponsor that is trying to provide products that really capitalize on themes that, can hopefully offer investors a chance to outperform the broad-based index over time. So adding a few of these themes to your core holdings in a complementary nature, we think could add some increased growth potential. I think there will be some increased volatility with these themes and additional risks, certainly, than the overall market. But we think over the long term, these innovative themes, and we have, now close to 20 of them, we highlighted 3 today, we think are really important for the average investor who wants to try to, eke out a little bit more growth on average over a long period of time. These, themes are kind of transforming our marketplace. In many cases, if you own the S&P 500 or a standard index, you have very little exposure to many of these themes and companies. So we'd encourage you to check out amplifyetfs.com, where we have a variety of theme ETFs, many income ETFs and core ETFs as well, over 30 now, with a bit over 9 billion in AUM. And we just appreciate being able to highlight a couple themes with you, Ed, on Opto, and look forward to speaking with you again.
Yep, it's always great. Thanks very much, Christian.
Thank you. Take care.